Good evening, ladies and gentlemen. We are here to talk about how to turn around rundown properties from liabilities into property investments. Um, the probably the first and most important rule that I ever learned in property was that you make your money when you buy. And really, what that means is that you need to buy at a discount. You need to buy at a low offer because then you're buying equity. And that's where real wealth is created in property. Now, the only way to make money when you buy is to buy at a massive discount. And the only way you can get a discount is when there's motivation, right? There needs to be a reason for the person who's selling to sell at a cheaper rate. Now, you've got distressed properties. That's a very good motivator. A property that's run down, hasn't been maintained, hasn't been looked after. If someone's trying to sell that property, there's probably going to be that many buyers, which means the seller becomes desperate, has more motivation, and therefore accepts sometimes a lower offer. A distressed seller, someone, maybe going through some sort of financial difficulties, and for now they've got a short-term problem, and that problem is property. So they want to sell a little bit quicker than they might have wanted to if they weren't in financial difficulties. So that's a good motivator. Macroeconomic factors. I think COVID was the most beautiful example of this. That with COVID, basically overnight, the property market fell by 20-30%. That was a massive motivator and a massive reason why a lot of properties were brought up into the markets. And then oversupply. When there are too many sellers trying to sell a specific area, that then means the buyers have the buying power because they have the options and can negotiate. So there are multiple different ways in which you can find a motivated seller, and the motivation equals usually the discount that you're able to get. And the bigger discount, the more equity you're buying, the more value you are creating. So I think the message of tonight's webinar is all about finding motivated sellers with properties that they don't want or can't handle anymore. That's where you get your good discounts, and therefore you get your equity. A quick introduction for those of you who don't know me, but I'm sure most of you do. My name is Lawrence Bull. I am a South African property investor. I'm also an author of a couple of books. Millionaire in the Making has recently gone out, and Financial Freedom Through Property is my first one. Go check me out on YouTube. I post weekly videos. Happy to respond to any comments or any questions on there. I do live deal analysis, so go check it all out. Tonight's webinar, we're going to be discussing 3 key things. Now, please, guys, also use the question function. Pop your questions in the chat bar, and throughout the webinar, I'll take a few breaks and answer them. So as something comes up or I talk about something that maybe doesn't quite make sense, pop out the question. The more questions you ask, the more engaging it is for me as well, and the more fun it is. So please help me out. So we'll look at how to find a distressed property, what to look out for when you're looking at these kind of investments, and then how to turn a badly managed building into a great positive cash flowing asset. So the first question is, how do we see these kind of investments? Okay. Now, I like to look at a distressed property or distressed asset in various categories. And these categories will differ by amount of effort required to fix the problem and the risk associated to it. Because basically what we're looking at doing here is to take a property with problems, solve those problems, and then it turns into a good asset. So as long as we know what the problems are and we know we can fix those problems, we can buy a distressed property. But there's different levels of how much effort and risk we're willing to put into it. So at the top of the pyramid, or for me, the easiest distressed property to buy into is a distressed seller. And the reason is simple. A distressed seller is someone who, maybe just fell on a bit of bad luck and wants to sell urgently. The property is usually in good condition, so there's no real work required. And with the motivation, you're able to get sometimes a cheeky offer across the line. So the risk and the effort required with a distressed seller is quite low. Then you've got the next level, which is slightly more risky and more intensive, a distressed legal case or distressed debt situation. Distressed legals, we're looking at things like a deceased estate where your debt could be outstanding utilities. Those are big motivators for people to want to exit a deal. But The risk is more about, do you know what you're buying into? Do you know how much debt? Or if it's a liquidation, do you know what other companies are attached or what other liabilities might be attached? Then you've got distressed property. This is when the property is run down. So yeah, you're doing renovations and you've got essentially a team of builders to fix whatever is wrong with property. The next level is distressed tenants. Now, this is when you've also got varying degrees, right? You've got a tenant that doesn't want to leave, but after 3 months, you're able to evict them. But then you've also got the 6 to 12 to 18 months tenants that are violent, that have guns. I'm actually in a situation now where we've got a violent tenant who has recently used a firearm in the house. And we're busy doing that eviction. Now, that's on the far end extreme. And that's something that, you definitely don't really want to be dealing with. Then you've got some cases that have got multiple issues. They might have a distressed seller with some legals and maybe a tenant that doesn't want to move out. There's multiple different ways in which you can find these kind of distressed properties, and your job is to figure out which one of these levels you're comfortable with, because each one comes with its own risk and its own rewards. In my opinion, the risk goes down as you go down this list. So distressed seller is the easiest, least risk. As you go down, you encounter more risk. So a little bit more detail around these different, buckets of distressed potential opportunities. So a distressed seller is someone going through any one of these kind of situations: a divorce, relocation, financial difficulties. They've been mismanaging the property and not getting the returns that they want, or they've been retrenched, or whatever. Those are quite common stories that you hear a lot in especially in this COVID situation. Distressed legals, any outstanding debts or levies. Those are big motivators for people to get out of deals. If you haven't paid your utility for 3, 5, 10 years, and there's interest on top of that, becomes quite a motivator. Your job is to get proof of what that number is. As long as you know what the risk is and you can account for it in your numbers and the numbers still make sense, you should go for it, right? Liquidation and deceased estate. Distressed property, this is the easiest one. You can see it. It's run down. It's in a bad area. There's structural issues, asbestos. That's something that's starting to come up a little bit more in the decisions I'm making. The asbestos in the ceiling is quite risky. Distressed tenants, they're not paying on time. They've got antisocial behavior. There's violence. I've done my fair share of evictions, and right now we're doing probably the most hectic eviction that I've ever done with this one tenant. So it's a lot of stress. It's a lot of risk. You know. Now, a question that I probably get asked most often is where can you find these deals, right? Funny enough, a lot of them are on Property 24. If you think about it, most distressed sellers, their first point of call, the first person they're going to go to is an estate agent, right? If you're looking to sell, you're most likely going to go to an agent. So Property 24 is a great resource. If you like repossessed property, you want to go and see what the bank has got a claim on, you can use a website called myroof.co.za. If you're even more risky or risk prone, you can attend auctions. You can go to the public auctions, which are all under sheriffhq.co.za. I've been to a couple of auctions. I wouldn't say I'm an expert, and I haven't done a deal through an auction, but I've put a few bids forward. You need to, I don't know. I think you need to be a very risk prone kind of investor, and that's not you'll see when I talk about some of the deals that I have considered strongly this year. As soon as it goes over the risk of aggressive, I tend to avoid it. So for me, auctions don't make sense, but for you it could. You've got your public auctions at Sheriff HQ. You've also got private auctions. That's where you're going with companies like Reliance Auctions. They're more like estate agents. They just give the facade that you're getting a deal through auction. Agents, I've bolded it because that's where I get all my deals. Once you've done one or two deals with an estate agent and they trust you, they tend to come to you with good deals. And then rental agents. Rental management teams are always working with distressed landlords. So if you can get in there with them, you can get some good deals. And then driving for dollars, that's what one of my students lately does. He drives through the streets, through the suburbs. He looks for properties that are run down, and he looks in the best neighborhoods for the worst properties, and that's how he finds his deals. So what we need to learn is to find motivated sellers with property problems. And that's how we're able to, I guess, fulfill the first rule in property, which is you make your money when you buy. We take a quick break here and see if there are any questions. Um, Also, make sure that you answer the poll. You can see that 44% of people are interested in the buy to let, a couple in the multi let student accommodation, and then the flipping. So, Michelle is asking, yeah, how can you find out how much debt someone has on a property? It's a good question, Michelle. Firstly, let me start by saying that I'm not entirely sure what the new poppy law allows or disallows. I'm not a lawyer and I'm not involved in that space. But what I can say is that on Lightstone, the last time I used Lightstone, they will tell you when the bond was registered on the property, and the amount that it was registered for. So let's say it was registered in 2010 with Standard Bank and the amount was 1 million. You can then go on Property 24 and use their amortization table, and you can work out essentially that if they were to have paid their bond repayments every month, after 10 years, it would likely be 500,000 would be the outstanding bond. That's the easiest way that I've come across. So Lightstone tells you what the bond, where it was registered, with who, and the amount. And that's pretty accurate. Cool, guys. Please feel free to ask more questions as we go along. I'm going to jump up to the next section, which is what to look out for. So, guys, this is finding and going for distressed properties, sellers, tenants, whatever it is. If you see a property problem, you have to realize that you're basically looking at and quantifying the risk. And your job is to look at the risk and say, can I fix the problem? Can I handle the risk? And does the return justify the risk? So we're looking at risk management, right? When you're looking at a distressed property or distressed situation, it's all about risk management. Now, I like to look at it on a scale basis, right? So I find that you've got your lower risk strategies, you've got your higher risk strategies, and then you've got a whole bunch in between. So someone who's maybe a very safe investor, I would say someone who's maybe slightly older, 50, 60 years old, what they're looking for is maybe more of a secure kind of portfolio. They want some security because they're going into retirement and they want to make sure that they've got stability. So they would be what I call, your conservative investor. They'd probably have a lot of investment in pensions and RAs and, income protection kind of policies. Somebody who's maybe a bit younger in their 20s, they're looking to start a new business, they might go to the aggressive route and go do stock trading. They might go and buy Bitcoin and or trade on the stock exchange and try and, there it's to some extent it's gambling because you're putting a lot of money in with maximum returns but maximum losses. And then you've got people in the middle, that are moderate. And the same can be said for property. So you've got high risk properties. Let me show you an example of one of the highest risk properties I looked at this year. I'll give you a second to just consume this while I have a sip. And the pictures don't quite do it justice, but this is a completely hijacked building, sitting with about 15 tenants or 15 units. And I mean, I don't think that a tenant has paid in this block for the last 10 years. So here are some of the property details, and please note that these are estimates. I didn't actually move forward with this deal because it was way too risky, but I wanted to use it as an example. Now, we estimated that a purchase price of probably 500,000 would be accepted by the owners. We actually phoned one of the owners, and they said they'd be willing to sell the unit for 5,000 rand. So that kind of tells you how little they were willing to accept. The buying cost would be your legal cost. Then renovations, I estimated 1.5. That might be a little bit too little. We didn't look in any of the rooms or any of the units. We weren't allowed in. There were very aggressive tenants in there. And then the outstanding debt, we also don't have clarity on that, but I assumed about 2 million. I just assumed for the last 10 years they haven't paid any water or electricity. So yeah, let's say that the total cost of this deal was going to be around the 4.2 million, which for 15 units is not bad. I mean, That's a bargain. But the reason why it's a bargain is because you've got so many issues that you need to be comfortable dealing with. The potential return looks stunning, If we were able to get out the tenants, fully renovate, a rental of 70 with expenses of 20 on a cash purchase, you're making 50 grand, 14% ROI. So it's a decent ROI. But for me, what it was just too risky. The risks. Here are the main risks that are associated to this one. Number one, will all the owners of the building sell? If they don't all sell, I've got an issue. If I can get all 15 units, then I can manage a body, then I can start a body corporate and I can manage the building as I want. But if I have other owners in the building, then I don't have full access and rights to the building. Will all the tenants move out peacefully? I can tell you no. They've been living there for years. They've formed bonds and they're not moving. What is the real outstanding debt? We can ask the municipality and maybe get a statement. The condition of the units, we don't know. We don't know what the structural integrity of the building is. So for me, looking at that building, you need to be a very, very risk-prone person to feel comfortable doing that kind of investment. So that's on a high risk tolerance scale. Remember that you can go distressed seller or you can go through to multiple issues, but your high risk strategy is going to be obviously high returning, but you could lose all your money. Where I like to play in the property space, I like to go from moderately conservative to moderate. Sometimes I'll go moderately aggressive, but that's more in my business and in my stock trading will I go more on the aggressive side. For me, property makes more sense as a long-term safe investment that in the next 10, 20, 30 years is going to give me financial freedom. Whereas maybe investing in stocks or in my own business, which is aggressive, moderately aggressive, then I can maybe afford to lose a bit more. So let's look at an example of a moderate to moderately conservative. That's a hard word to say. So this is the most recent block that we've bought. If you've been on some of the previous webinars, you will notice it. I've been talking about it for a while. It is 6 times 3 bedrooms. The reason why this was attractive is because this is a distressed seller. They're an inexperienced landlord. They don't know how to manage this kind of investment, and therefore they're mismanaging it, and it's turning out to be a liability. And then here are the 3 key risks and issues that are associated with this distressed property. There are a large number of renovations required. All the units need to be revamped. The roof needs a bit of work. There's asbestos in the ceiling. There's the delinquent tenant, the one I briefly mentioned, who you'll be learning about more just now. And we're going through a very heavy eviction process with them. And then the property's been completely mismanaged from an OPEX perspective. And that was probably the biggest and easiest fix for us. So these are the 3 key sort of risks that we figured out through our feasibility study. And with these motivations, we were able to secure a 30% discount. So on the market for 2.9, I think, we got it at 2 million. Yeah. So let's look at these three specific areas in more detail. Number one, the property was a distressed property. It had lots of renovations to be required. We had a building inspector go in and do a detailed analysis. There were some issues on the roof. Each unit needed a lot of renovations and work. So that's one issue with asbestos. Distressed tenant. So highlighted in red, this is a message from our letting agent. It said, the tenant in unit 2 says that it's unit 4's friend that broke in and started shooting. Unit 4 also have people living in their garage. And those people living in the garage were just basically doing drugs. So I mean, this is definitely the worst tenant that I've ever inherited. Our agent believes that it's going to take 8 to 9 months to get rid of them. We have contacted an attorney who says it might take 6 months. So you've got multiple ways in which you can deal with this tenant. You can go the legal route, which is what we've decided to do. But if the tenant starts to become more and more violent, at some point, you might need to get a little bit more aggressive with your stance, and maybe hire a private team that can safely exit this person. So this is, I think, going into this deal, we knew that this tenant was a problem. We knew that the previous owner was busy evicting them, but we never knew about the violence never knew about the handguns and that kind of stuff. So it has definitely been a bit of a shock. But that's the risk that you take, guys. As much as you can do a feasibility study, as much as you can do due diligence, you might not always know the extent to your issue. And then the final issue was that it was being poorly managed. And this was a great win for us. You can see here line that the line that's highlighted in red. Rates and taxes and water and electricity was roughly about 80,000 on this building per month, which is shockingly high. It should definitely not be that high. And the reason why it was so high is because they weren't recovering properly from the tenants, and there were leakages, water leakages in multiple units. So as soon as we saw the water bill for the first month, we got a plumber in there. The plumber fixed all the taps. Our water bill is now back to normal. We make sure we charge our tenants recoveries. Easy to fix those kind of issues. Getting rid of the tenant and doing the renovations are slightly better projects to take on. It's all about your risk tolerance. Where do you see yourself? Are you a conservative investor? Well, then you probably don't want to go for the distressed property strategy. You probably want to go just maybe your buy to lets, or maybe you want to go new builds. Maybe you want to go something a little bit with it where there's some capital appreciation. Are you on the aggressive side? Do you want to take on a hijacked building that's going to take you 2 years to fix, but once you fix, you're going to make so much money. The potential return is so much greater. Are you in the moderate space where you maybe want someone who's a distressed seller with about R500,000 worth of works on the property, which maybe sounds like a lot, but that's not that much in comparison to a hijack building. So you've got to weigh up the problems that this property presents, because remember, the problem gives us the discount, but with the problem we also have to find a solution. Otherwise, we bought a liability. 5 key mistakes that amateurs make. Before I do that, let me just quickly check if there's any questions. So, besides the bank, what other funding options can one explore? That's an interesting question. So, funding comes in multiple forms, but your three main forms are institutional, private, and creative. Institutional financing are your things like your banks. Now you've got your well-known traditional banks, ABSA, FNB, etc. Then you've got your more boutique banks like Mercantile, Combined Finance, Sentinel Homes. Those are more like boutique, tough. As an example of that, they fund more property investors or developments. Your private finance are private individuals. So people with, maybe you find one wealthy individual with a few million, or maybe you find 10 people with 100,000 Rand each, or you do a stokvel where you get 100 people to contribute whatever per month, and then every however long you buy properties. That's private finance. And then creative finances, that's when you're looking for creative ways to do a deal. So rent to rent, you rent a property and then sublet it. You don't actually buy the property yourself. Um, Sourcing, where you find the deal, package it, and sell it to an investor like an estate agent would. That's how you can also get some financing. Into Ituileng, are distressed properties good for flips? Yes. Great point there. If you enjoy flips, which is buying, renovating, and then reselling, distressed properties is the best way to go because there's easy motivation. And the whole point is to redo or renew and thus add value for a higher sales price. So that's a very good question. Koketso, can we able to access the recording? Yeah, so this is going to be recorded, added to YouTube within a week. So get yourself subscribed, click that notification button. Michelle, yeah, and the photos don't do it justice. It's an absolutely terrible building. Last question, Juliet, how do you buy property without your name? Not sure if I understand you, but you can buy a property in a company or in a trust. And that's how you can separate the liability between yourself and your entity. So that's definitely something you can consider. Okay, 5 key mistakes. Please, guys, do ask questions. I'm loving it. If you've got anything else, please post it in the comments. The 5 key mistakes that amateurs make is they think, number one, a low market price means low cost. So what does this mean? Going into a place like Berea and buying a 100,000 Rand property doesn't mean that it's a good deal or that you bought a discount. You have to understand that there's a market value per area. So in Berea, the market value of that specific property might have been 100,000. Just because 100,000 sounds cheap in relation to a property, maybe that's the value that that property has. Low cost does not mean low market price. Number two is that amateurs don't realize how much effort and energy it requires to buy into a distressed property or a distressed seller. There's a lot more hoops you have to jump in. There's a lot more effort you have to put in. And if you're not, if you're someone who wants to maybe passively invest in property, I wouldn't recommend you go down the distressed route, because the whole point is to buy something that's broken at a discount to fix it. But if you don't fix it, then you've just bought something that was valued at whatever you bought it for, which is, there's a lot of unanticipated risks and hidden costs, especially for people who haven't been in the property market for a while. There's a lot of costs that you might not be sure about. Eviction costs, for instance, the process, the length of time, sectionalization costs. There's a lot of things that, you know, people don't know until, what is that saying? Either way, you're going to pay your school fees. You're either going to pay it to learn from someone, or you're going to pay it by making a mistake. And that's how you sometimes learn about these hidden costs. Amateurs cave too quickly, they give up too quickly when the going gets tough, and unsure of risk tolerance. Probably the five key mistakes amateurs make regarding the distressed property route. And unsure of risk tolerance is really the most important. I find that during the viewing is your opportunity to really vet what the risk of this deal is. So on simple questions like, what is the owner's reason for selling? The agent is trained to not give too much information that could disadvantage the seller. Their client is the seller, so therefore they're going to say everything in the best interest of the seller. So they're not going to say they're going through a horrible, messy divorce, they're in deep financial trouble, and because this property is owned by the two people that used to be in love, now they desperately need to sell. They're not going to say that, because that would be disadvantaging there. So you have to try and listen for cues. If the person's leaving, going away, relocating, divorce, you must listen for these subtle cues. Very important. What repairs need doing? You can walk through the property. You can take your builder with you or an inspector. See if there's any damp. See if there's any issues. It's a great chance for you to see what kind of work would be required. Check in the cupboards. Key bit of advice. You'll see a lot of damp issues inside cupboards. Um, and then when you find any of these issues, I love to nudge the agent. Every time I see something that's not in place, I say, "Ooh, that light's going to need to be fixed, and that's at least 2,000." And then the electricals, I'll probably have to spend another 5,000 on electricals, and this bathtub needs to be replaced. You need to put something nice in here. That's another 10,000. While I'm running these numbers, or while I'm throwing these numbers out, all the agent is thinking is he's starting to add it all up. And by the end of the viewing, I would have said, there's 120,000 rand to invest. And he'll be like, yeah, because he heard me these small amounts all the time. And then it's a lot easier to negotiate the agent down and say, look, we were at 1 million, but I didn't know that there was 100,000 rand worth of costs. I mean, let's meet halfway. Let's go down to 900. I don't, that kind of thing. You can negotiate a lot there. So what to look out for is whether you've got the risk tolerance to take on the distressed property, and also if you've got the solutions. And you can pick up a lot of what to look out for at the viewing. That's where you're really going to get your key bit of information. Okay, we're going to go into the final section. Let's see if there's any questions here. Question from Dean. If you want to buy a property in your company's name and the company isn't profitable, is the application based on your personal affordability? Okay, so the way the banks work is they will usually finance a company, but the company has to provide 3 years of audited financials. So your company has to have 3 years of trading experience before the bank will loan money to the company. But what you can do is you can register a company brand new. You can still get financing through the company from the bank, but then the bank is going to take your personal liability as your personal affordability as surety. So that means is your company will receive the money, but if your company defaults, the bank's going to come after you. So that you don't have that protection anymore where you're differentiating yourself from your company, but the bank also can't take the risk of, you know, your company just disappears and runs away. Great question there. Let's see. Would recommend investing in rates or something similar if you're not ready to own your own property? It's a great question. I think rates are a great way to get some exposure to the property market, especially if you're a passive investor. If you don't really have the time or the energy to go and look and hunt and negotiate and structure deals, that's the thing I love doing. But I appreciate that that's not everybody's cup of tea. Rates is a way in which you can basically, almost like a stock trader, buy small bits of property related companies. So I do have a YouTube video on how to invest with 500 Rand, where I talk about different ways in which you can do rates or stocks or, kind of trading that gives you some exposure to the property market without actually having to be a specialist. Michelle, I don't know how to gauge how much repairs will cost. 100%. Is it best to first schedule a viewing by myself, then with another builder? Yes. So I would recommend that go yourself. You can you can estimate as you go and view more properties and you do more deals, your confidence will come. I also didn't know what things cost, but now, after a bit of experience, you do learn. So you first go by yourself. You need to first gauge what's the level of motivation. If you don't think the seller's motivated or the property's in pretty good condition, you're not going to get a discount. You might as well walk away. You don't need a builder to go with you. But if you go to a property and you see a lot of potential, you've already maybe pre-negotiated a verbal offer with the agent, you can see that they're kind of interested, then I would pay for a building inspector to go in and do a detailed analysis. Costs about 5-6 grand. It's not a lot of money, but they go in and do a very, very detailed scope and give you a pretty competitive or pretty accurate cost. Or last section, how to turn it around. So we've kind of spoken about, what distressed properties are. There's different levels, there's different risk appetites, there's different, work required to fix things. We've also looked at how you can find them, where you can find them, and then what to look out for. Now, let's say that you found an investment and you want to turn it around. What steps can you take? Okay. First thing, as I mentioned in the beginning of the presentation, this is all about risk management. All of it is about risk management, but you cannot manage what you cannot see. If you look at a building and you say, sure, I mean, I think it's like a good investment, but you don't know it's hijacked, you might buy that property on the premise that it's fully tenanted and they are happy tenants. And when you finally sign the documents and the money is transferred, you actually see that you've got 15 tenants that don't want to pay. So risk management is all about being able to see all the risks so that you can mitigate them. Let's look at this one as an example. Okay, this isn't necessarily a distressed property, but I want to talk about how important it is to see everything that's involved in a deal. Now, this is how this property was presented on Property 24. It's a 2.5 million rand block of flats. It's providing a net return of 15%. It is fully lit and well maintained. It's in great condition, and it's got rates of roughly 2,400. Now, most newcomers to the property game would run the numbers something like this. They'd find that the rent is 31,000. They'd minus the bond. They'd minus the rates and taxes which the agent provided them, and see that income minus bond and rates and taxes is 10,000. That's my cash flow. And based on the money I'm putting in, that's a 15% return. That seems like a pretty good investment, right? But there's a lot more that meets the eye than just looking at those expenses. Here are 5 hidden costs that most amateur or farm investors are not even aware of. Vacancies, operating costs, repairs, insurance, zoning. So when we add these additional numbers in, first of all, we'll take a vacancy rate in. This building, I can assure you, is going to have months where there's a tenant not in one of the units. You're going to have some delinquent behavior, depending on the profile of the tenants. So you have to put some money aside for the inevitable emptiness that's going to come from a tenant moving out. Right, your OPEX, your operating costs, your things like your water, electricity, your Wi-Fi, whatever it may be. If you're doing a student accommodation, that would be your Wi-Fi. You've got repairs. Now you're going to have to put money into this. You're going to have to fix the geyser every now and again, repaint. There isn't. Most people that buy property buy in a sectional title, and then the body corporate looks after things like your geyser. Here, you are the body corporate. So anytime a tenant has an issue with the property, they're going to come to you and say, hey, my door broke, please fix it. So you need to put some money aside for that every month. Insurance, have the building protected. You're looking actually, when you take all the numbers into account, not 10,000 Rand cash flow, 900, giving you a return of 1.14, and then throw an additional zoning cost of 90,000 Rand to sectionalize them into individual units. It's all about seeing beyond what could go wrong. It's all about what you see. If you don't see the risk, you can't manage it. So there's 4 steps that I usually follow when turning a liability. First of all, you need to be aware of your strategy and your risk appetite. That's step number 1, because that's going to decide what kind of properties you look at. Number 2, once you've got that, you can then start doing feasibility studies on properties that interest you and fit within your strategy and risk appetite. Then once you've done the feasibility, you know what the risks are, then the next step is to figure out how you're going to plug those holes. If you can find all the problems, you've got awareness of all the problems, and you know how to fix all of them, you've got an ability to turn a liability into an asset. And then what you need is a professional team of people to help you plug those gaps. Guys, I'm not an eviction specialist, and I doubt that anybody on this call is. You don't want to be doing the eviction yourself. But if you know that an eviction is something you need to do, you need to have the right professional person who can tell you the process, the timeline, the costs, and can essentially do the work for you. We're not builders. We need builders to come in and do the renovation. So you need a team to make things happen. So starting with strategy, if I look at myself, these are the 3 strategies that I like. I like distressed sellers, I like distressed properties, I like distressed tenants. The reason why I like distressed tenants is because I know the eviction process, having done it a couple of times, and I feel comfortable that it's quite a guaranteed way. I don't like distressed legals and debt because there's a lot of unknowns, and I don't like multiple issues where, like that hijack building, that's too much. My strategy is to find cash flowing multi-lets and blocks of flats. So I need motivated sellers, I need tenant problems, I need properties that need work. Buy them with cash, sectionalize them or change the zoning, refinance, recycle, put into the next deal. So I'm avoiding overly complex or risky deals. I don't want to be aggressive, I want to be moderate. Okay. So that's my strategy. It's my risk appetite. That's the first thing you need to identify. And just to talk about the strategy a bit more, releasing equity, because a lot of people ask me about the refinance process. So with this specific building, we are required to buy this property cash, because the bank won't finance a block of flats like this, because the bank sees it as one title deed. So there's 6 units, but it's all on one title deed. So what we need to do is first buy the property and then go through the process of legally sectionalizing it into 6 individual units. Then we can go to the bank and get a home loan on each one of those units and thus raise competitive finance. And that's how we can pull the money out. We then recycle into the next deal. We again buy cash, we fix the property, we sectionalize it, we pull the money out. Okay. So if we're looking at this deal in a bit more detail, remember there's asbestos in the ceiling and a lot of renovations required. There's delinquent tenants and mismanaged expenses. Let's quickly go through the feasibility study that me and my partners did to make sure we understood what this deal was all about. So our feasibility study looked at many things, right? We looked at gross yield, we did deal analysis, we looked at reports, we looked at financials, but there were 3 key things that came to our attention. Number 1, there was one really bad tenant. Here you can see some proof. Unit 4, when we bought the property, they were in 125,000 Rand arrears. I don't know what that is exactly. Let me take my calculator. Okay, so they owe us 125,000 and their rent is 4,500. So they have missed 28 months of paying rent. They haven't paid for 28 months. The second big thing was the renovations. So what we did is we had a building to go in, do a detailed analysis of exactly what needed to be done. We got a report. We sent that to several builders. We got quotes. So you can see here that the total cost and labor materials for just the internal works of the building was 380,000. There was another 100,000 for sectionalization costs and another 100,000 for external renovations and the asbestos. So we know we're in the market for about 500, 550, right? And then we also knew that the OPEX was not being managed. The water was constantly overcharged. They weren't recovering the water, and there were leaks in multiple units. That's why the water didn't work. So when we looked at this, we had to quantify the risk. Evicting the tenant, this is the highest risk. This is the worst part of this project. The risk is 10 out of 10. We've got a violent, delinquent, non paying tenant. The renovation is not a high risk. I've done many renovations before. Most of them work out pretty well. Sometimes you undercost or underquote. Sometimes your builders are useless. But I mean, you can always fire your builder and then move on to the next one. And then the managing correctly, this was a low risk. All we needed to do was fix some of the taps and some of the plumbing in the unit, make sure that we recovered from our tenants accurately and that they paid on time. Risk was low. We've had a look now at the feasibility. We've looked at what the key risks are. Those are the three key risks. I mean, there were other risks as well, but those are the three big ones that we said if we could figure them out, if we could turn them around, we've changed it from a liability to an asset. So, as I mentioned, fixing the water is simple. Fix the leaks, appoint an effective managing agent, correct tenant behavior, and manage effectively. This is something that took us a month to fix. We just went in, fixed the plumbing, the water was fine. The second big issue was obviously the renovations. So we've done an urgent renovation list. We've got into each unit done. The key right now needs to be fixed, otherwise the tenant's going to leave. That resulted in about 50,000 rand for the total units. And now we've got another 2-year plan to fix everything that was listed in that building inspection report. That's going to be what, the 500,000. And we're going to pay that over 2 years. We're going to use the rental income to pay that off. So this is a 2-year or 24-month time to turn this building around. Then we've got the evicting of the tenant through a legal route, and this is probably the biggest unknown. We're looking at between 6 to 18 months and anywhere between 20,000 to 120,000 Rand, based on the different quotes and estimates we've gotten from lawyers. So we factored all of this into account. We ran our numbers and we found the offer that works for us based on the risk we feel like we're taking. Okay. So our numbers worked out quite nicely. You can see here that the black has been changed. It was 18,000 was the taxes and water and electricity. It's now down to 3,200 because we're passing the water and electricity on to the tenants. Um, our cash flow on this deal is 4,600 after we've refinanced. So once we've sectionalized and refinanced, giving us a return of 15%. So once we've refinanced, pulled our money out, obviously we'd have a bond repayment, which is listed there, and our cash flow would be 4.5. So our return, once we've fixed and plugged all the issues in 2 years' time, is going to be 15%, which is cool. Final step. So you know your strategy, you know your risk appetite, you've done your due diligence or your feasibility study, you've got a turnaround plan, you feel confident that you can execute, you know what the costs are. Now you need to reach out to the professionals to be able to give you those quotes, estimates, etc. These are, in my opinion, the 9 key people that you need. A property coach, someone like myself who's done a lot of these kind of things in the past and can essentially light the way so that you don't have to make the same mistakes. And it's obviously important. You need someone who's bringing you stock. You need a good builder or architect. You need an inspector. You need an accountant, a finance broker, someone getting finance on your behalf, a bond originator. You need an insurance broker, an attorney, and then a letting agent, someone who can do the management. If you have these 9 people in place, you are ready to take on a distressed property. If you don't, then potentially you must take on a lower risk investment until you've built this network to support you. That is how you turn a distressed liability into a positive cash flowing and wonderful asset. For those of you who are interested in my coaching program, please go and check it out on lawrencebull.com. You can also schedule a quick appointment with me, where we can talk about your situation and whether a coaching scenario would help you or benefit you. For those who are serious about the coaching, please only contact me if you're ready to buy a property in the next 3 to 6 months. The whole point of the coaching experience is to help you make a decision. Not really just to educate you. You can get all the education for free on my YouTube channel, but more about helping stimulate action and taking actual steps towards making a purchase. My coaching is very structured. There's lots of milestones that we'll figure out. We go through 5 structured sessions, and within 3 months, you should have a deal on the table. So if you're ready to make a buying decision, you're just a little bit nervous, you want someone with experience to look over it, please look out for my coaching program, schedule an appointment, and we can figure out if it's the right step for you. Let's see if there are any other questions. Okay, let's see here. So we've got Juliet. Is it wise to have more than 3 properties in your name? Tax implications? So no, I would say it's not a good idea to have too many properties in your name. In your personal name, because as you earn more in your personal name, you go higher in your tax bracket until eventually you're at the highest income tax bracket, and then you're getting charged 45% tax. Rather put it in a company. That's my advice. That's what most accountants have advised me to do as well. Michelle, is it necessary to do the zoning? It depends on the deal. If you're doing a student accommodation property, you probably need to get it registered as a commune if you want to get NSFAS accreditation and you want to get funding for NSFAS students. For us to get finance on those buildings, we have to sectionalize, we have to change the zoning. If you're buying a property, a house, and it's zoned residential and there's only going to be one family living there, you don't need to change the zoning. So it's very much dependent on the deal that you're doing. Why is zoning so expensive? Great question. There are 3 key players in the zoning process. You've got the architect who does the drawings, you've got the town planner who does the engagement with council, and then you've got the conveyancing attorney who does all the legal side. And each one of them has a certain cost associated. So actually 90,000 Rand is probably too low. I would say your architect's going to charge you anywhere between 30 and 50,000, depending on the size of the building. Your town plan is going to charge you 80,000 to do all the applications with council. And it depends also if the property is old, it has to go through heritage, which is a department in council that tends to be very slow and expensive. And then your attorney is going to be another 30 to 50,000. So you can be anywhere between 100 to 200,000 for the rezoning of a large property. Does the sectional title help with lowering the risk? And can you get a home loan? Yes, so you can get a home loan on the sectional titles, and it does reduce your risk because let's say you have a block of 10, you can sell off 5 of them, but you can still hold 5. So you can reduce your exposure on that specific building if you wanted to. So it's a nice way to exit part of your investment, but still hold and maintain part of your investment. Michelle, wow, 125 in arrears. It's crazy. But the scary thing is, for me, the payment delinquency, I never expected them to pay. I wasn't worried about that. But once we saw that there was shooting and there was violence, and now our other um, tenants are feeling unsafe and at risk. That's what didn't sit well with me. Tiana, so what LTV does the bank grant on refinance on blocks of flats? So if you've sectionalized, you can get home loan rates on these different units. So you can get 90 to 100%. I've got a quote of 100% on a block of flats, but it has to be sectionalized. And then what you'll have, let's say you have 10 units, Standard Bank will give you three loans, ABSA will give you 3, FNB will give you 3, and Nedbank will give you 1. The banks don't want to have full exposure on one investment. They want to have part exposure. It's the same in the buildings in Berea. Not there's no bank that's funded the entire building. They have to reduce the exposure. Juliet, how do you get that team in the place when you're a starter? So Juliet, one of 2 options. You can go and just go out there and hustle and do it yourself, and spend a couple of years building the team and through just experience going to some networking events and building that team up. Or you can also join a coaching program. In my coaching program, I do give access to all my students, the team that I've developed and built. So it depends. Some people like to do it on their own, and I appreciate that. There's lots of networking events, and you can reach out. You can use Google. You can find people, and through vetting and experiencing them, figure out if they're the right person for you. Or a lot of property coaches who have experience and have the team set up already. You engage with them on a coaching level, and you can get access to them. Charlie, if you only do drywall for rezoning, do you need to go through the process? No, so drywall, I mean, usually the rule of thumb is if you're changing the structure, you need to get approval. So if you're taking out a wall or opening up a place, or you're putting in a new room, you're doing quite a substantial amount of structural work, then you need to get approval from council to move forward. If you're doing drywalling, probably not. But like let's say that you're going to take a house, you're going to put drywalling and you're going to put 20 students in there, you're probably going to need to get it registered as a commune. If you're going to take a residential house with drywalling, you're going to turn it into an office complex, then yeah, you'll probably need zoning. So just to put drywall in won't be a big enough reason to get rezoned. But it depends how much substantial work that's going into it. So guys, it is now 7 p.m. I don't see any other last questions. Let's see what the poll ended up with. So 42% with buy-to-lets and 30% multi-lets. That's awesome. I hope that you enjoyed and learned something from tonight's webinar. If anything, please know that distressed properties come with risk, but they also come with reward. If you can understand the risk and feel confident that you can resolve it, then a distressed property is probably a good way to go. Let's end off with Tion's question. Do you always rezone or get consent on multi-lets with, say, 3 or 4 units? I'm not quite sure what you mean there, but the process that we take is to rezone the whole block. So, if there's 10 units, we'll get 10 title deeds, and then try and get a loan on each one.
Are you tired of having more month at the end of your money? It's time to venture into property investing. And although it may seem scary, don't worry. We've created tons of resources to help you get started. From tools that help you analyze deals to online training courses to one-on-one specialized coaching. Click the link in the comments below and get started today.